Okay, we're live. Hello there, I'm Mitch Goldberg. Welcome to my live stream, Be the Boss of Your Money. The reason it's called Be the Boss of Your Money is because I wanted to bring a show that was just more than uh, information. I wanted to bring you, and I continue to do this, to bring you perspective so that you could be the boss of your money. In other words, so you could take control of your money. It's very easy for your money to take control of you, and everything you do is about the money. But that shouldn't be the way it is. Everything you do should be about you, the things you enjoy, your family, you love, your needs, not the other way around. That's what the show is about. We do cover a lot of things, in particular the stock market. And why do we talk about the stock market so much here? Well, for one thing, it's exciting. It's part of the global economy, world finance, inflation, recession. So we talk about an awful lot about inflation, how it affects you, what to do about it, where to look for it. Part of the show, though, is also about doing nothing. Not me doing nothing, not you. I'm not saying we do nothing. I'm saying that sometimes we are so tempted to do something with our investments, to finagle with our investments, to make adjustments, to tinker. And when we know that the more we trade for like 99.9% of us, the worse off we are. So sometimes you need to know enough, more than enough, however I should say it, to do nothing. So you could say, I'm not worried. Because if you're making moves and rash decisions because you're nervous or worried about the market, we want to stop that from happening. Because we all have this innate fear or flight instinct, right? Fear or flight. And that's actually the worst thing for investing. We need to like cut that emotional response out. And you do that by having the self-assuredness that you are controlling what's in your control and just letting everything else work out, believing that everything else is going to work out. Okay. That's in a nutshell. I hope I did this justice. That's what the show's about. Okay. That's exactly what the show's about. So we don't want rash decisions. Does that make sense to you? If it does, how about this? Give me a thumbs up, please, a heart, an applause reaction, a wow, whatever the reaction is available to you, depending on which social media platform you're watching from. We stream to a lot of social media platforms. I'll put them right over here. Okay, right here. So follow me on any of these. If you're following me on one, follow me on another, because sometimes I post different things on different platforms. But I do know that there are some people that just never go on LinkedIn, or there are some people that are only on Facebook, or some people are only on Twitter or only on Instagram, which is why I'm on all of them. If all of my tribe, everyone I knew was on just one social media platform, I would just be on that platform. But I know you're different. So, we're on different platforms for different reasons and for different needs. So I don't have a sponsor for the show. I pay for the show with my own time, with the equipment that you see in the show. So I really appreciate your support by you giving it a thumbs up or some kind of reaction, or what have you. It helps get the word around. It helps everybody else in your timeline to see the good work that we're doing here. This is all about financial education. There's no selling that goes on here. It's just about financial education, answering your questions. I anticipate what your questions are going to be. That's how I get the topics for the show in my mind. And then I just go with it. You believe it or not, there were, like a day like today, I literally flicked on the cameras, I flicked on the lights, pulled the microphone like this, right into view, and I went live. And so there were days like that. Today was certainly one of those days. So, but I'm glad you're joining me. I'm Mitch Goldberg. Again, you're watching Client First. You're watching Be the Boss of Your Money. I'm with Client First Strategy. We already have somebody out there. We have Russell Cohen. Hey, Russell, thank you very much for the 2 thumbs up. Mucho gracias. Thank you very much. Muchas gracias. Okay, so let's roll the quick intro. And this is going to be a fun show. It's going to be a quick show. I think my shows have been getting a little bit quicker, which is a good thing. Here we go. Thank you so much for joining me. You're watching Be the Boss of Your Money. It's my live stream. We do this every Monday through Thursday uh, at 4:30. It's all about personal financial education. We talk about investing, interest rates, borrowing, the economy, inflation, credit cards, insurance, Medicare, you name it. We talk about this stuff here, mortgages, housing, home sales, blah blah blah. It all has to do with money, and money is emotional. And the idea is to help you keep your emotions in check. And we go over into a lot of really good stuff here. So, a couple of things I want to share with you first. Oopsie daisy, and then I want to get into the heart of the matter. We're going to do something a little different. That sounds interesting, doing something a little different. We take a look at some stories here, okay? Let's take a look at Doordash. Let's just start with that. Let me get rid of the social media icons. They're covering things up. Okay. So I have here the quote up here on Doordash, down about 5%. And even though the chart, the 52-week range is 257, if we do the all chart, I guess that's not the chart I was looking for. Okay, whatever. It's really not so relevant. But the highest is 257 for DoorDash, and now it's 71. So it's like a $25 stock going down to 7. Okay, let me pop myself up in the screen over here. Okay, so here's DoorDash. What's the deal with DoorDash? Why is it down? Okay, DoorDash is down because of the ultimate nightmare for any company, especially companies that are uh, running on a super thin margin that often lose money in order to survive while they grow their user base. Amazon is buying Grubhub. Now, if I was the CEO of DoorDash, I'd be like, now I'm not just competing against Uber Eats and Grubhub. I'm competing against Amazon, which, by the way, Amazon owns Whole Foods. So, Grubhub just got pretty serious. That's like a major entrant. It's no longer Grubhub, it's Amazon. So, if Amazon wants to get into the cheap food delivery business and crush what are already the thinnest of thin margins, I I would be concerned if I was a DoorDash shareholder. I'm not making a prediction that this is going to be a bad thing for DoorDash shareholders. I'm just saying that, you know, when you have a competitor like Amazon who could get into any business they want and their shareholders always excuse them for not making money in a new business, it's hard to compete with that. Okay. So let's take a look at the other big story. This is the story that I don't really give a shite about. And that one is Twitter. Twitter was down 11% today. Do you care? I mean, seriously, this whole thing with Elon Musk and Twitter. So Elon Musk was going to buy Twitter for 40 some odd billion dollars. The stock was going to be in the 50s. And everyone knew this. I mean, it was all over everywhere, all over the financial media, that with the tech stocks plunging, with Meta, that's Facebook, getting crushed, and all the other, big tech stocks, the only, Twitter would have gotten hit also, except that Elon Musk said he wants to buy the company for the $50 range. But now that he's gone, there's nothing to really hold up Twitter. Like, Twitter is not fundamentally a particularly great company. It's like they barely make any money. It's always a struggle for them to seem to be able to monetize the user base. And now that Musk is out of it, the stock is getting crushed. This is what I always say, and I used to be very into takeover plays back in the day. Okay, uh, there was a time in my career when takeover plays, M&A, mergers and acquisitions, was my specialty. That was my thing. But I've always said, if you buy a company for an acquisition to be, because you expect it to be acquired, you always had to make sure that the company, the fundamentals, the stock could stand on its own without a takeover. Okay, because actually buying a company with the expectations of being taken over and then it actually happening is not always so high. So you really need to have a backing for the company. And Twitter just, it just didn't have it. Okay. So those are the two stories that I want to highlight. Okay. We've got someone out there. Um, Elon screwed Twitter. I would tend to agree with that. Elon Musk says he's going to buy Twitter, and he's like, I don't know enough about the fake accounts. And by all accounts that I've seen, they gave him the information that he needed. They're ready to negotiate. They're ready to put the deal together. I think Elon Musk got buyer's remorse and decided, you know, he could probably buy Twitter for a lot cheaper, um, especially with interest rates going up and high flying stocks like Twitter, stocks with high valuations going down. That's not the chart that I wanted, but Twitter is down 25%. The S&P 500 is off about 20%. Year to date, 19%. Okay. Yeah. That's what I'm looking at. The S&P 500. This is the S&P 500. S&P 500 is down 19%. Here we go. 19% year to date. Twitter is down 25% year to date, but from its all-time high, it's down even a lot more than that. 73 to 31. That's like a $7 stock going to 3. That is, more than 50% drop from a high. All right. Let's take it to the board then. Since we're here, I want to talk to you about the yield curve, a few other things. Again, Russell, I do tend to agree with you on your assessment that Elon screwed Twitter, but it's hard to make somebody do something. And if you were a Twitter shareholder, hopefully you got out of Twitter while the stock was still up. Let's take a look at the boards. Pop myself up here. All right, so the Dow down 164 points. Not really that big of a deal. I don't really pay attention to that small of a move. I'm aware of it, but it's not something I ruminate over. NASDAQ down 2.25% today. You see that? Down 2.25%. That's a pretty big drop. S&P down over 1%. Nice size drop. 1% or more definitely gets my attention. Gold continues to sell off. Oil staying in the low 100s. This is interesting. The 10-year Treasury down to 2.993. I kid you not. I bought some long bond, some bond ETFs for some clients, and one was like, "Oh, but we know interest rates are going up, though." I'm like, "No, it looks like more like recession to bring interest rates down than to go up." You remember what I said to you? I think we've seen the peak in inflation. And as you can tell by I don't know if you remember this, but we went over this last week. We went over all the commodities. We went over this, wheat, cotton. We went over lumber. We went over copper. All right. They're all down year to date and down a lot. I mean, raw materials are just plunging in price. That's going to start to feed through the inflation chain pretty soon. It takes a few months. There's a bit of a lag, but that'll work its way through. VIX was up a little, 1.5 to 26. To be expected after a day like today. Let's take a look at the bond market. I think this is the more significant thing. The 2-year yield, 3.07. The 10-year, 2.996. That's about a 0.08, more than a 0.08 differential. About a 0.08 differential. I'm looking at this one. So three over here. I'll tell you exactly what it is. That differential, this tracks the 2-year, 10-year spread, negative 0.06. I'm sorry. Negative 0.08, excuse me. Negative 0.08. That's an inverted yield curve, meaning the 2-year yield is short term, the 10-year yield is long term. So the 10-year yield, you'd expect to have a higher interest rate than the 2-year Treasury, right? We're talking Treasury. So the 10-year Treasury, you would expect to have pay a higher interest rate than the 2-year Treasury, which you'd expect to have a lower interest rate than the 10-year. Sometimes that flips. So we call it inverted. When that happens, it's interpreted, it means banks aren't making money to lend money. So if banks hold back on lending, slows credit, slows growth, hurts consumers, hurts businesses, that crimps demand, slows the economy down, brings inflation down. But what it's telling you now is we're heading into a recession. I've been saying we're there already. After Friday's labor figures, if you recall, we had a really big jobs number this past Friday, like 350,000 jobs were created, way higher than what was expected. So that took the recession argument off the table for a lot of people, not for me. You see, labor is a lagging indicator. Labor will be the last part of the economy, the last statistic to fall when we go into a recession. By the time labor starts to fall and the unemployment rate starts to rise, you would expect the stock market should start heading up on anticipation of an economic recovery as opposed to go down because of a recession. And that's the playbook, guys. That's what I'm going by because that's the way the playbook has always worked. So I'm sticking to that. No need to change that. All right. So that's really the whole enchilada. That's the ball of wax, and don't have a lot to add to it. I hope you guys all had a good day, a great weekend, and I will be back tomorrow at this time. If you think of any questions that you meant to ask me during the live stream, or if you're watching this in the replay, hit me up in the comments so I can see your question. I love hearing from you. It's the best part of doing the show. And I will see you tomorrow. Thank you.